Hey, thanks for joining us, and don't forget to hit the subscribe, the like, and the notification button for more. Okay, everybody, it's Kevin Wadsworth and Patrick Karim, NorthStarBadCharts.com, and we've got a treat for you today. We've got the market sniper, Francis Hunt, joining us today. Hi, Francis, how are you doing?
Very good, guys. Thanks for having me back.
Always good to have you on the show. Always good to have you here. Okay, there's been a lot going on with the markets, the metals, and cryptocurrencies, and some strange things being said by particularly the Federal Reserve. They came out with some very strange comments a few days ago. Do you want to just cover that for us and tell us what you think about their double speak?
Yes, I mean, in the prelude to this, I was absolutely saying we have to cover this on the basis that it's typical weaseling and wiggle room searching on their behalf. So why? And for those that aren't familiar, let's just what happened and what are we discussing. So if you search under Twitter or any other place, the Fed and the recession, you're going to get a couple of people that are already commenting, and you're going to get the actual official statement, which is just below this one. There's someone that looks like a young elongated muskiness with a blow dry, but Wall Street Silver.
That's what Pat looks like if he takes his hat off.
That's right.
So
exactly.
keep that cap on, Pat, because that's what happens to Pat's hair.
Note the philosophical. We're having a more holistic look at the data as the Fed preparing to declare a non-recession tomorrow. So there's obviously a growth number that's going to come out, which is clearly going to indicate that you've had, and it's quite finitely defined. A recession is 2 quarters of negative growth. So Q1, I'm assuming, I'm not up to date, but I'm pretty sure it was negative. That means 0.0 or less, 0.1 negative is a negative quarter growth. And I'm expecting that it's going to be statistically relevant, that you'll probably be in another negative quarter for the end of June, which we're receiving now a month later. And the comment that came out of the whitehouse.gov, which is obviously on behalf of its central banking in chief, private corporation for the banks. This is the key bit. What is a recession, they say? Suddenly they're in the business of education. While some maintain. So first of all, you have a very hard, tightly defined static definition. 1 + 1 = 2. 2 quarters back to back that are negative equals a recession. End of. Now, note the mealy-mouthed English. While some people maintain that 2 consecutive quarters of falling real GDP constitute a recession, that is neither the official definition nor the way economists evaluate the state of the business cycle. Well, actually, it is. It's just you that are weaseling like all hell and trying to conjure up a new set of rules. Instead, both official determinants of recession, based on this data. So they want to include labor market and holistic aspects. Here's a key word as well for you in here, holistic. We're going to look at it at the broad, we're going to look at other things. Of course, we've got this red hot economical employment market for pizza delivery boys, et cetera, et cetera. And you've got to bear in mind that that's super bullish and all of this. So it's unlikely. This is the key conclusion after all of these other things. We're going to look holistically at other things. So now it's no longer specifically about a growth number over 2 quarters. It's now, if we feel that there's things that are really, really strong, recession's an ugly word. Let's not use it. It's unlikely that the decline in GDP in the first quarter of this year, so there's the confirmation that it did decline, even if it was followed by another decline in the quarter, indicates recession. So quite clearly, they've had sight of the number. Quite clearly, despite the inflation, we're still going to have a reducing quarter or again after a previous one. So what does this mean? Well, it's come out through wh.gov, but have no illusion in your mind that the cartel of central banking that has control over the pricing of money, aka interest rates, et cetera, are the drivers for this message. And that in the highly likely event that you do have 2 negative GDP quarters, they are going to continue to insist that that's not really a recession anymore. The official, quite tightly defined definition no longer applies, and they're going to start weaseling. So the question that should happen is, why are they not acknowledging something that by factual definition has occurred? And why are they electing to say, but don't focus too much on that? There's all these other great things that are going on. Well, this is my assessment, and this is on balance of probability accurate, and I could be proven wrong, but we've continued to assert that you will be pushed past the normal point of pain in this process of the current tightening. The cover story is inflation, but inflation's got too big. And it's a pretty good cover story because it has absolutely got too big. It's far higher than the official number by BLS, et cetera, et cetera, et cetera. And the goal should be to rein it back. But there's also an unstated, undiscussed agenda item, which is the BRICS nations are coming much, much closer to making some major announcements about alternative financial systems. And the whole concept of when they docked Russia's money was very short-termist, very win now, but lose long run. It was very much win a skirmish and a battle for the day, lose the war. And this invariably further motivates other nations. And there's been a storm of other nations, not just Iran and others, that all want to be part of the Brazil, Russia, India, China, and now sitting where I am now, South Africa club, that will be in an alternative system. So the dollar has precedent of doing this before when the euro launched. And the euro launched at 1.6 and it ran all the way down to 80 cents. You're talking about a 50% reduction in cross valuation. And this is what the dollar did as we went into the 99-2000. So it's very much, and I've used this analogy before, the aging silverback gorilla that likes to beat its chest when one of the young teenage males are starting to show their relative strength and how they might perform. Only this time, they're a whole bunch older. And instead of being a very politicized euro that kind of was happy to submit and just glad to get all the systems and their cash and their new notes out, you are talking about a much older silverback. So they will continue, in my opinion, this is my reading between the lines, which can be wrong, you can form your own opinion on this, to press home the pain far deeper, because by doing so, they kill the US consumer so that export of dollars by consumption to the other nation states that need a steady inflow of dollars, Triffin's dilemma, you always export dollars and run deficits, and you import foreigners' products. Toyotas from Japan, Hyundais and Kias from Korea, and Mercedes-Benz and BMWs from Germany. So what ends up happening is those dollars stop going over, you stop buying their goods, and we need an ever-inflating supply because of dollar-based debt and dollar dominance. So they drive the price and the value of the dollar up to make those thinking of tipping into the new world realize that the old mafia is still the baddest and the strongest on this block. Don't pay the new mafia. That's my take.
Yeah,
that's a lot of stuff, man.
There's a lot to unpick in that. It's clearly, you know, the mood music has been for a while, hasn't it? That these moves are taking place with the BRICS nations, and it's been interesting just to see how the dollars reacted, how the US dollars reacted, and also how the Fed now is pre-positioning markets with its, as you say, mealy-mouthed words. Fascinating stuff going on right under our noses.
And I think they're preempting the fact that if they get a second quarter and it's technically a recession, everyone would expect the backing off of rates, and you would expect further softness in the dollar because the dollar has been in a pullback state. It tapped out on the Dixie at 109. I think it just did a technical touch of that point, and we're around 107 at the moment. We've seen the euro did the classic, just like the euro Swiss franc that we said is going to 0.71, and we set it up at 108. When you run parity, you don't want to be climbing in at the 0.99s. Your immediate reaction is a rally. You got that on the Swiss franc. I can just remind people of the quick charts as well, if I go back to sharing. And you had the exact same event occur with the Euro USD, straight into a rally that took you back up to the levels 102s, 102.5s for those. So let's just show you those key points on the currency side. Euro Swiss franc, which we've been calling for a big collapse to occur on the euro versus the euro. Look at it, you're at 0.97. Man, it's spilling today. Look at that candle, it's awful. Oh my God, I haven't had much time on the charts. I've been getting a few items for my daughter on holidays. This is beautiful. That's smashed down. So just to be clear, on the euro Swiss franc, guys, we are actually calling for a 0.71 to be run on a third fail. Can I also highlight, I have real precedent with this. I'm the only guy I know who's called 3 crashes successively on them, 2 of which occurred. And we're in the process, in our opinion, of the next one occurring. So it's ironic. It's really exciting to check this out. Don't forget, when the dollar is weak, and it will have periods where it pauses, the short on the euro with the Swiss franc is a very strong portfolio balancing trade. So I've also looked at the currencies that will be strong when the dollar rests. And so you keep your yen and Japanese, Korean won shorts, you keep your euro shorts, and you have 1 or 2 smaller other currencies apart from the dollar. And this balances up your grid. But this is awful. Can I just show you this? I'm so glad we actually chanced on this. This is a horrible rejection. But you'll note that hammer here. And I'll just highlight it because we're on the monthly now. This hammer was the run of the parity level. What did you get? Straight away, you got a channel rally. We said that should be faded, but it will rally for a bit. So if I put those lines back and I jump back out of the big time frame and take you into the daily, you'll be able to see that parity run. And this is exactly what's kind of happened with the Swiss franc. You see, you run the parity on the blue line there. The fat blue line was your parity run. Bang. What did you get? Snapback, congestion, wind up here. And then we did all the TA here for this double top, the neckline, down to here. And then you had this as a breakdown, back targeted back down here. Then you got a rising wedge in here on a lower time frame. And this is beautiful. Man, I'm loving this on the euro Swiss franc. I haven't checked it. It's great when you just see a move that you're in that's making money. So while the dollar is almost a little bit off, the Dixie still goes up because the euro is 52, 53% of that. But the dollar is not particularly impressive right now. You're seeing the Swiss franc absolutely eating the euro now today. So what happened here? You see the parity run. That was the main reason we came here. Now we go to the euro USD and you're getting a similar thing. So I'll just wipe the face of those overlay draws. Go and watch the euro USD. What happens? You ran the structure. We actually had an inverted HVF with a target down here. Isn't it beautiful? When you get a structure, there was our funnel. You had a perfect structure. We were dealing with this in the community, and you took it. And this is the value of targets. You got out, bang, you made the run. That's also a parity run. The parity line should be on this draw. It's roughly there. You make the parity run. What do? You rally up to 127s. And now you're rolling over a bit, but you're rolling over much harder now on the Swiss franc than you are currently, because the dollar's kind of, even when the dollar's resting, it's not the weakest of all the currencies. It's just not the main, it's not number 1 on dominance. It's in the middle of the pack somewhere. That's going to be your weak dollar days during this period of dollar dominance. And here you go. So a rally after parity was the point I was making. So dollar currently pausing. This is also a problem for your Bitcoin and your crypto guys, because actually Bitcoin should be doing a lot better in this environment. This is our key point to our crypto guys. And this was answering the questions that you were being asked. Is physical Bitcoin the new world currency? I don't know about the physical side of Bitcoin. I would have to investigate this further. I would argue I'm not able to answer. If he's referring to precious metals by that, I'm not sure of the nuance in the question here, by the way, Patrick. Have you seen any further clarity? Gold is money by default. Are you in touch with the Bitcoin is a receipt for imaginary gold? The dollar is defunct. Gold is money by default. Precious metals, it seems like a precious metals bull post. I don't understand physical Bitcoin because I don't think that exists, but I think he's referring to it as a precious metals concept. And I think I've got fairly good news on precious metals, but within the confines of the US seeking to drive a stronger dollar generally, and in a current pause period, probably because this is what I always find when big information is coming out, like a recession data, which is likely to come out very soon. It's amazing how the pause started, a week or 2 ago. on the dollar index. So it might be worth highlighting the dollar index and how that dollar dominance started to come back off recently. It's funny how people seem to have the news before the news. It's almost the Nancy Pelosi effect in that we've had our pause now with the dollars, and it coincided with Euro USD parity run. That makes a big headline. It proves my hypothesis. Trading news is fatal. Headline news is fatal. You need to be trading the news before the news. And this is what the inverted HVF gave you, the downside break towards the one level. So yeah, I'm unpacking quite a lot of stuff and I'm monologuing a bit. So I want to give you guys a chance to jump in there.
Well, there's one thing when you showed me the Euro CH, I always considered the Swiss franc as the fiat currency's gold equivalent. And that Euro CFC Swiss franc chart is actually practically the inverse of the XAU EUR chart. So it looks like the gold chart or CHF EUR, yeah. And if you overlay the Euro CHF, it looks practically the same, or the inverse of or it'd be the CHF/EUR.
That's an interesting one. And of course, I would imagine the Swiss sits on an inordinate amount of gold and sound money. And Switzerland, you know, they're a square flag nation. It's like the Vatican and the City of London. There's a big deep dive to be done in there for people that are interested in that, but I don't want to take you there myself. But I was just highlighting here that I was expecting this to turn into some form of a rising wedge, seeing as you brought up gold against the euro. And it's quite important to note, and I haven't again come to this chart in a while, that you're getting a hammer and support on our legacy target of 1686. So many people forget that our single dollar oil call was also a long at gold during the same period. And when you have a look at the euro, this was our upside HVF that we had on that. So when you were over here, this was the break, and we were saying you want to be long gold, particularly euro, and this was the same for the pound. Gold GBP, Euro GBP, and we were getting in on a small falling wedge there and running it up to this target and taking off at this target. And it's amazing to see that target, you know, you were late 20s, and we're now 2 years later and you're back at the same price. So you've gained nothing and you've been underwater most of that time, but for a couple of months recently. But are you going to squeeze higher in what I consider to be a type 3 rising wedge? In other words, a third impulse in the corner there and melt up? Or will we actually have so much fear created, you can't rule out this probability, that the dollar dominant super spikes, where we can see the USD Korean won setups, further weakness on the yen, a lot more going on, where they ignore the recession and actually get more hawkish to everyone's shock and horror, killing the consumer, driving dollar strength, which is a hypothesis most people, I think, are undervaluing. And as a result, the gold could actually, even across a weak euro, have a pullback one more time before squaring up and going. But so there's a bit of a mixed message in that. It could be either. And I'm open to be both, but I'm a long-term investor. And I think if our charts, my stagger charts have loaded up, I've got an interesting insight on the commercials versus the retail, which we can pivot to in a bit. But gold's got to be accumulated, and in the long run, it's going to melt up against the euro. We're seeing, just imagine what the euro, and to Patrick's point regarding Swiss franc, I think it was it gold, euro, Swiss franc inverted. Maybe I should try split my screen and put them on, so that point can be made that you were on, that you were bringing up. It was Swiss franc.
Yeah, or CHF EUR.
Euro, Swiss franc inverted.
Yeah.
Swiss franc EUR, yes, the other way around. Yeah, you know, you can see it. I'm going to put it on monthly so that we're apples for apples there, and you can see the similarity there. And this is a current, there is a lot of similarity, but of course there was the manipulation. So I've always said this should have been, if you had just taken the fact that the Swiss wasted a lot of money, this should have been a high that was like that, which makes
gold
it
shows the truth.
More like the gold. Yes, indeed. And then 2018, then you started to go up. But you actually overperformed. The gold overperformed even Swiss franc during this period where it was just walking out. So it's a very interesting point. And you're seeing this collapse This is such a bullish 2 candles here after 2 hammers on the 95 and just testing the 1 there. So again, you're seeing the same things just upside down, and it's really, really powerful.
Is your target 115, the measured move? Is that like 85 minus 95, not minus 85 added? So it's like almost 110, your target for the CHF euro.
71, 0.71.
Okay, yeah, if you do the...
So you will need to 1 over that. So it's further than you think. And we see the dollar probably going lower than 0.85 as part of this. Despite that fact that the dollar's unimpressive at the moment. So if you were to invert that, if we were to get to 7.1 and run it, it would be 1.4s on the CHF euro chart.
Just one point to bear in mind with all of this is, as DXY is rising, it's not rising as fast as inflation, which may have a little bit to do with why gold is showing a little bit of relative strength, because gold does tend to act as a barometer and measure loss of purchasing power. So gold at the moment is doing 2 things. It's reacting to dollar strength, but it's also being pulled by loss of fiat dollar purchasing power. So if you do DXY over PPI ACO, that's the US dollar index adjusted for PPI, then you're looking at a very different chart, and that's actually broken down. So DXY in relation to inflation has broken down, whilst DXY is of course going up. So that kind of is something that people really do need to bear in mind, because
which will tell you inflation will remain in America. America will still have inflation. They just won't have as much as the nations whose currencies they are appreciating against. So they are exporting. Why I regularly say they will export some of their inflation to Europe, Britain, Japan, Korea, and
so
other
Francis, do you see gold and precious metals either decoupling from the DXY and just ignoring the fact that DXY is rising and start reacting more to inflation, or do you see gold and precious metals suffering a large drawdown initially ahead of any future moves to the upside? What's your sort of big macro view on precious metals?
So the macro view I'm highly confident on. The short and medium I'm less so. So the macro view is it should be part of everyone's portfolio, and I'm not the 5% guy. I think in reset economics you apply reset rules. People weren't 5% equities and 95% bonds. In the buy the damn dip on the proliferation of everything, asset price inflation of both the bond and the equity markets that we've had for the last 40 years. So I don't intend to be 5% gold. But that, I think I'm applying the economics of reset economics and hyper stagflation. So that's my diagnosis. So normal IFAs, I would sound like I'm a dangerous man talking dangerous stories. But you've got to look at the gold-silver ratio and recognize that you are getting in very thin Everest-like altitude for oxygen. There's only been one other point where you super spiked beyond the levels that we're at, 92 at the moment. In fact, even the 2009 capitulation that was part of the great financial crisis, right now, you are beyond that. And if you listen to Keith Neumeyer, you listen to my best man with a great sense of humor, 69, what's his name again? I can't get it to stick when I'm talking live, but I can never forget it. Who worked with Sprott. Help me. Anyway, you talked all about
the metal guy there. Jesus.
Uranium metals guy. I just can't do the name just for whatever reason. My brain won't store it. But he's a lovely guy. 69 years old, wry sense of humor, and I've had him on my own program, and I'm totally embarrassed. But I'll hammer it in home one day. But anyway, he's spot on as well. At 92, they only pull out 8 ounces of silver for gold. And Newton, when he originally founded, and I've been reading a number of silver books, and Keith Neumeyer referred to this in his part of that interview. Newton guessed around 15, and it was a great number. They had 15 as an average, and actually that slipped to 8. So the truth of valuation by scarcity is that it's almost impossible to be a unique silver miner. For miners right now, the inflation has gone up and up and up. They need much higher gold and silver prices. And this is going to set up the scarcity and the shortage and the fall in demand. And it's like uranium. You have these long 5-year, 10-year oversupply moments, and it builds up like trains with a bungee cord. You know, the front runner starts running, but none of the other carriages run because the bungee cord builds up the tension and he stretches. Then eventually the stretch is no more there, and you start pulling the second carriage. You know, the locomotive starts pulling the second carriage, and then they start going, and suddenly all the carriages start eventually being pulled, and they play catch up. The back one suddenly gets lurched forward, and then when the locomotive stops, you get all the shunting back up. And so there's these big lags that build up through the system. And right now, that is absolutely occurring in mining. So miners are hopelessly undervalued. You were mentioning that, and that's my opinion. And you're sitting at 92, which has been, but for one other occasion, the all-time peak where you get resisted on it. And the closest value that miners who specialize in this, real bank trader and long-term miners who worked in copper before going into silver, like Keith Newmeyer, but also understand the banking system as they came via that route, they're saying it's only 8 of these buggers out there for every 1 ounce you pull of gold. So already at $2,000, which we should be well beyond, but the market's what, 1750. We'll have a look at it now. 1699. No, that's euros. What's it? It's about 1750 in dollars. Let me just see. 1720. You know, silver should already alone, if you were just 1/8 of that, you would be substantially higher.
That'll be about $200. Yeah.
So this is very bullish.
Yeah.
Sorry, carry on.
So some of the metals, in particular platinum, I think is incredibly undervalued in relation to both gold and silver. So the precious metals markets are fascinating. When you pull up a platinum to gold ratio chart, it's very, very telling. And I do get the sense that we're building towards something quite spectacular. But like you, short term, it's
short term. That's
very,
right.
very dicey.
Macro bull, short term. If they do a peak fear event, whether it's this monkeypox that they accelerate, they're going to kill the inflation. They've got to do something more demand killing than they did last time in 2020.
Yeah.
So I mean, that literally sounds like Klaus's bank hack, because there's no way to kill demand better than the SME shutdown for 2 years that they pulled, and most businesses, except the oligarchical, pro World Economic Forum agenda crowd, there's no bigger way than literally taking everybody's money out of their bank accounts. I can't think of a way that you could do more demand killing behavior than you did in March 2020. Apart from that, so or doing a repeat with the monkeypox, and who knows. So we can speculate. So if in the event of that, and they have with their responses continued to add, the central banks are merchants of volatility, not stability. Each successive fix, overdue, moral hazard, revert, is giving us a megaphone. And I've done this, and I've shown this in one of my YouTube clips. So I'm going to owe you a couple of charts on the back end of this, because pulling these out, I've not got them all to hand. So I'll pop these out on Twitter or do a clip with you. But I will show how recently the Fed funds rate searching, it's got ever more volatile. The central bankers and their responses, with their cabal of collaborators from World Health Organization and onwards, are just adding ever greater dumps and pumps. And I fear the next dump is literally a total demand killing event. And in that environment, you would have to say gold and silver is going to go down, because people are going to chase liquidity, but that price will be meaningless. And that period, that 6 months, that whatever, food shortages, God knows how dystopian it may get. And I'm not a doomsday prophet. I think if you prepare for the worst, everything that comes in above that, you're better prepared. So low bar it, and the rest is gravy above you. If you go in too optimistic, you get surprised, you're underprepared, and you get kicked between the legs, and then you're in a whole world of pain.
Good analogy. Good analogy. I'm just trying to think of some of those questions that we had on Twitter there. There was one.
Yes, I'll go back to that.
Was there one about uranium? Was there one there?
So uranium market. Yeah.
Mm-hmm.
So this is again very much on the energies. So the energy complex, you're still at the $100 mark. You've got WTI $3 or $4 below, and Brent $3 or $4 above. We're saddling the $100 mark. And you're doing this in an environment that we're about to probably get an announcement that America is in recession. 2 negative growth quarters in a hyperinflationary environment, virtually. Almost hyperinflation. Double digits is the definition of hyperinflation, actually. You start to be considered hyperinflation. Obviously, it can go up to hundreds and thousands beyond that. But when you're getting into teens, one of the definitions is it's considered hyperinflationary when you start getting deep into the double digits, by truth. The BLS and all these guys work really hard. There's a lot of countries at just 9. Have you noticed that? 9.1 or 8.7 or just below that key 10 number. They really don't want to have a double digit on the inflationary. Yet you're sitting with oil at basically 100, splits the Western Texas Intermediate and the Brent contracts. In fact, slightly above that, because you've got Brent almost at 107 here, and you've got WTI at almost 98. And so when you start to talk about uranium and the other energies, they absolutely are going to start looking great value. They already started a great turn and a run. I'm just going to do, the question was around URA, which is very specifically an ETF on global uranium. So let me answer the question specific to the investment. But you can have a look at 2011, how high it has been. And that wasn't even the emergency circumstances of what we've had. Then you can look how far it fell. It was the great unloved at 6.9, having fallen from an unbelievable level of 133. The fall is the unbelievable bit, not the 133. And I can certainly long-term see a very, again, it's a bit like the gold and silver, a very, very promising future for energy, because a lot of people are coming back to realizing nuclear should never have been stigmatized in the way it was. This price behavior, however, does reflect an increase of volatility. Some people will argue there's a bit of the fear and potential for what we call a complex head and shoulders in this. So if I was just necklining this, I'd go around the 1850 number, and you could get a small rally during this period, say a rising wedge, and that could be a foregoer to that fear stroke demand killing event, and you have the complex M head, as we refer to it in our jaws, like that, and you've got the neckline visit all the way down here. And always when you get this complexity, a little learning treat, it's usually in the midpoint of it, and you can see how perfectly that does that. So we do a lot on head and shoulders that you won't find anywhere else, and that is midpoint. So when you get complexity like W inverted head and shoulders and M inverted, you'll usually find it in the midpoint. So that's a correct draw, and that's possibly a neckline visit. So I might increase that 1850 almost to a 19, just so that I trim the wicks on that, because some of the M's come all the way to the neckline and some don't. It's not a golden rule. But you get a rising wedge here. You could first have the big sell-off on the uranium. You could be back down to levels around here, 11s and 10s. This is just a rough sketch, by the way, so that's not mathematically correct. We'd have to measure it properly. You're talking around 30. I'm in log scale here, so it will vary. And the overlay draw is not a log tool. So do this in reg to check it out first. But you would get quite a significant sell-off back down to around these 12 levels, potentially. But that would be on such extreme fear, and any form of return to normality and any form of proliferation that would follow as medicine for that would almost certainly see you surpass the highs and continue in the bull market. But this price behavior is quite rest orientated, but it doesn't have to be a head and shoulder, because there's also a bit of a descending grind line here. You could also have, if you mess around long enough, you could also have some degree of falling wedge structure. So if I'm being the doomsday porn artist and we have a bouncy, dodgy quarter or two, but nothing unbelievably nightmarish, you could then pop out of the falling wedge. So there's a number of scenarios where you can still go up on URA on the global X uranium ETF.
You know what that looks like, Francis? Well, look, silver did your downwards move. So if you put silver, it went back to its breakout levels of 2020, and uranium's just hanging in there, outperforming silver. But it definitely, there's a roadmap for uranium to go and tag, because I feel like silver leads the show. Like it's the first one to get out. Well, gold's the first one to get out the gates, but then it's silver, then uranium. But silver or JDX and all these gold and silver miners, they've shown the underperformance. And look, they did that bearish destiny that you're drawing up now for URA. They actually they did it. Look, they're back there. So
Yeah, just bring that up with you. Get them both on weekly and put them under each other. And it's easy to spot the, the COVID event that's there, the big spill. Then they shot up. Silver shot up really early compared to energies. You're right about the early response. This was still part of our gold bull. In fact, gold shrugged off COVID pretty well. Had two little dips, one big dip in the middle and bounced, and then continued to new highs, while other things were slower to get going. You had a slower hike there. But then once silver peaked here, it kind of went sideways, and then it was all about the energies. But we draw what we refer to as trumpeting, which is a broadening structure on a bull pole. And it typically means when you start to get more volatile like this, you break through the lower line, which has happened. And so you now broke through it, and you have a return move, and then you have to wind up and reconsolidate and rebase build before you can make new highs. And there's still scope possibly for further downside. So the thrashing, when you have the three impulses the other way, and instead of it being a wedge, it's a broadening structure. What you end up getting here is it's getting too thrashy, and that means it smashes out the side, which is the lower line, and often sells off or has to reconsolidate, square up, tighten up again, because it's got too volatile. So it needs a calming period before it then re-goes. This was the silver COVID period that you're referring to, Patrick, quite accurately at 18.4 that you back down here. So there was, you started to run with silver, then there was a little bit of a warning, then the big event, the main event showed up, and then you remade the 18.5s, you had a small dip. That's an inverted head and shoulder, and that gave you a very good target up top there that you've not, had you taken, that would have been your best involvement in silver, but you are now down at a structurally very core supportive level. So Patrick's charting comments is first rate and spot on.
Yeah. Well, you're like us, Francis. I appreciate your comments because we look at so many charts, and I see the way you built your watch list. It's like, it looks like hours, like you start seeing these patterns, these instruments, and you see, oh, well, we're correlation masters or pattern recognition. I would rather say that's our specialty. We're like human computers recognizing these patterns.
Patterns are the way to go. I mean, I take people away from indicators. I speak poorly of them. I'm not here to insult anybody personally, and I don't know where you stand on them, but I take them off indicators unless it's volume data. You're getting new data. And outside of volatility measures, Bollinger Bands are useful and other things. I try to take them off and get their focus more on patterns. And this is my great concern for the Bitcoin bottom callers. Look at this on a monthly chart. This is not even a monthly, this is a weekly chart. Here was your 2.5 year super setup that broke here that we called for. This was the one moment you wanted to be leveraged long. You had that head and shoulder. We did actually say you're going to rally again, take the falling wedge. You're going to get the upside break on that. And then since the 50s, we've been deeply concerned about Bitcoin. You had the three flags. Now, this hasn't been the fourth flag. The three flags work beautifully. It's probably gone a little high to still be categorized as a flag, but I fear for people that show up on a chart like this, off this amount of price behavior, and start screaming bottoms. And it doesn't matter how much your on-chain analysis is telling you, but it's never been this low on wallet movements, creation, all this other fundamental info. The point is, Bitcoin is a tiny paper boat in a little calm bay most of its life. And now you're having regular tsunamis that are coming. And, it will just engulf you. It doesn't matter how good your shit is anymore, because you're only one part of the FX trade. That's where the benefit comes from having been an FX trader. It's a two-part trade. It's Bitcoin against macro. And dollars in the macro cycle where wants to assert peak dominance. And if you split this chart and you show dollar dominance, from when our dollar bottomed, this massive run, the best run here, and this is worth reminding everybody of, because there'll be crypto peeps that are watching your awesome content and deserve to do so because it's great stuff. I love seeing what you do and should be watching it. And if you put the Dixie under that, it's directly. And people hadn't made that association. They think it's all about them, Bitcoin, and the world. And there's these belief systems that have been constructed in and around this, and they get too ahead of themselves on it's all about crypto, and it's the new life, and it's the libertarians have been held. And, you know how the stories go. And I just feel sometimes I have to check people, check them on their biases. And it makes me sound like I'm an Uber bear. I'm not an Uber bear. I don't aim to be bear. We were exceedingly bullish during this run-up period. But look at this chart of the two. Let me line them up underneath each other, and you can see this. Dollar dominance is awful for Bitcoin. We had 6 or 7 trillion printed here. And that's what it did for the dollar into there. Well, what did Bitcoin do during that period? It was a hyper leveraged anti-dollar trade. We coined the phrase, the anti-dollar, for a specific reason. And then it continued to get momentum and a lot of hype and hopium while this inverted setup here. I should use a straight line. That's messy as all hell. And you got the inverted. Again, there's your W head. And you got your 2 shoulders there, tiny one there, all at the 94.5. We said, guys, this break is FX is the new crypto, dollar to run. And it's going to take out previous highs and it's going to continue to run. And this is what you got. And since this breakout, you draw the line vertically up from when the inverted head and shoulders started its reversal period. And you've got the story of Bitcoin and the story of the dollar. You know, so understanding what the dollar does is the crypto game. And I can look at this on this big chart and I can still go and draw a bear flag right there on the weekly. Doesn't matter that you got a 24 technical touch. You couldn't hold it. You were rejected like a dog outside a butcher's house and you're back down. So for the crypto guys on the Bitcoin side, understand you're in a macro environment where the old system, so sometimes when I listen to Raul's right on so many things, and the Real Vision guys are sharp there. I respect everything that they've done, and we all get to be wrong and right on many things, and the whole exponential everything. But the problem is you've got to kill the old system because people suffer from inertia. You have to make them demand a new system by killing the old one so that you can give them the solution you've been preparing. And that's where your CBDCs come. And then I question, how much is Who Ate All the Pies, Mr. Carsten's, going to want Bitcoin around when he's telling you that you can't buy any more meat this week with your central bank digital token? And you also tweeted something nasty about government and you've lost 400 points, which has reduced your daily allowance on expenditure on cigarettes and alcohol, rada. Well, are you going to allow a totally free to spend currency to compete with your highly regulated, controlled currency? I don't know. I wouldn't if I'm the boss and dominating everybody. But anyway, that's just a reminder. Again, dollar is the other half of Bitcoin. And what I'm saying for the long term, we have had a massive rest. We made this was a massive rest. Bitcoin did nothing. There's a blow off. You can construct a shooting star on a lower time frame there. If I roll this into a fortnight chart, which let me do, you have a perfect shooting star. Doing macro candlesticks, guys, is some of the best things you can do. And I know, Patrick, I'll probably have your support as a technician for that. Macro candlesticks for direction, simple candlestick analysis. You don't have to be clever and drawing circles with sine and pi projection waves into 40 years into the future and becoming a sci-fi wizard. Just having a look at that. This is a very, very strong market that has gone, and it's had a small pushback and a small dip. But you don't want to call a top right now on that, on the big time frames. With this, still got a target outstanding to the 111s. No. And you can get overperformance on that. And if I remind everybody of the Dixie main charts that we always talk about, this is the story. This is the story. And I come back to talking about the same things. The story, the real driver story is macro and the dollar. If you can best understand what the dollar is going to be doing next in this environment, it gives you so many leads on what's going to be going on generally in Bitcoin, assets like the equity market, which, as I said, we're equally concerned for. You are going to be on the right side of the market. Be on the right side of macro. You cut your problems down by a whole bunch. If I show you this one on the monthly and I take you back out to the super big time frames on this, this has been our draw and it's continued to, it's actually not the one I want. That's the one I want. This has been our macro draw on the dollar. This is death of euro and yen. And that is the Western world indebted nations. It doesn't mean the death of the Aussie and the CAD. We have backup trades against the yen on CAD. Why? Because it's got energy, it's got oil, it's got a lot of things. We have an HVF mega structure on it. I have an HVF mega structure against the pound with the Australian. So actually the commodity currencies are going to become kings again. That dollar milkshake, we are not dollar milkshake. We are dollar dominance for now in this measure that is the Dixie, against the euro and the yen, which are the main components, and the pound in there. But in actual fact, we are far broader in our FX views. Brent just gave me the narrative story for when I was seeing Dixie, Brett Johnson. He said, that's the first person that's been able to explain to me why I'm seeing dollar long on the chart. We saw that long bias many years ago. And he was unpopular while it was going down. I said, he's got the right story, just had the wrong timing in this down leg. But it is not just those currencies. We've got amazing setups on the Aussie pound and that community members have found in our areas. Beautiful monthly setups. I love those. You set and forget. And the carry cost on interest rate parity is much lower because it's a bit like the USD yen. They can't charge you too much. There's no interest charge on the Japanese. They've got a lower interest rate than America. How expensive can they make you to have a long carry? It's different if you're trading the USD TRI. You've got to catch the key pump moves. Otherwise, the carry hold on that is awful because he's got a higher interest rates. So this is the key, and it keeps on keeping on. And we're in the part of a next channel move up where we're expecting 111 at minimum before you get a sustained rest. And this is still runaway dominance. And this is a pause. And it's going to throw everyone off scent. And now you're getting the Bitcoin callers calling bottoms. And when you go back up to those bigger time frame charts, and I had the Bitcoin up there, it's still a flag on a macro chart. It's still even potentially a flag, never mind a megaphone or some other continuation pattern that goes a little bit higher. And that's my concern for crypto kitties. They're going to get hammered because it's high beta and it's high liquidity. And if we go peak dollar dominance for another session, that goes down. But it's also going to be terrible for the Robinhood call option holders on the likes of ARK and Tesla, etc. They're going to have an equally tough time. And actually, it could be very terrible for many people's pensions. The only thing that's happened that's a little bit of concern to my hypothesis is we're having a sustained pause at the 3% level, which we expected on treasuries. And there may have been, and I've highlighted this, so we keep open to anything that threatens our view. I don't want to marry the view. It just keeps on keeping on being right for now. But there's a few threats that have shown up that have said one or two things. And the 10-year is one of them. So if we look at the 10-year, so this entire funnel range has been resistance here, it's been resistance there, and now we've broken that resistance. Let me just take all my annotations off just so that everyone can see that beautifully first. You can see it here, and you can see it here. Now, we shooting star ran the 3.4. We broke those key levels, and now we're having a little bit of a pullback. Is there space and enough time for us to have a 2% pullback? Will we go that far? Well, that would be quite a big pullback, and that would be fear. Where does that come from? I take you to the lower time frames. There is a little bit of structure where there may be a head and shoulder in here. So what happens if yields start to give up? Well, just because it starts to look like a head and shoulder doesn't mean you're going to get it. So you've got to wait and see. But we have drawn it and said this would be a challenge to our hypothesis, because this would then mean bonds start getting bought, yields start coming down. That means they're not pushing the rates up. They're not going peak pain. The pain is already here. And that means the pain's already here now. It has something broken already. We just haven't heard about it. So we're keeping our mind open.
So that goes with it. Is it today that they're saying recession or not recession? Is it today?
I haven't been on the airwaves, so I'm a bit out of sorts. I'm back for this interview, so I've been driving around and not too much on the charts and the news. So we'd have to check Forex Factory. I can pull it up quickly and answer that.
Yeah. Well, when I see your chart, that means the market's pricing in the fact that they will accept a recession and they're going to start halting rates, and then market's going to start pricing in maybe rate cuts, right? If that chart's hanging there,
yeah,
it's like the market's saying, okay, that's it. They have to admit there's a recession. They have to cut rates, or else it's like.
I think there's a statement tomorrow.
I think it's Wednesday, Patrick.
Yeah,
yes,
tomorrow.
I think you're spot on. I think it's Wednesday. I've just moved to the Wednesday there just to highlight that. So you could start to have a breakdown, and then the Fed says we don't care. We don't treat it as a recession. The inflation's too high, and plenty of pizza boy jobs going out there. You can become a waiter anytime, and we're paying a bit more because of the inflation. The economy's great. And then they could
Francis, can I just ask you to put the TNX chart up there? It
sure.
goes back to the 1960s, and just zoom right out onto the monthly.
Yeah. I always watch this in log scale, which is why I say this was the most brutal snapback we've ever had in rates.
If you put that on the non-log scale and zoom out so you can see it right the way back to the 1960s.
I've got only up to the. Actually, you might be right. You might get the 60s. I know I've got the 80s peak.
Yeah. Okay. So if you look at the 1960s, there you can draw a support line under the rising trend. So in the 1960s, leading up to 1980, you've got
he
there you
has
go.
those lines.
Yeah. So there you go. And then from the breakdown in 1980, instead of the chart following a rising support line, it was capped by a declining resistance line. So you can draw a declining resistance line from 1985 all the way to 2020. All the way down. There you go, 2020. So what's happening now, by my analysis, is a breakout and that blue line that you've got, that horizontal dashed line, is a critical spot there. And I think I've probably got my line just a tiny bit lower. If you can maybe zoom in and look at the candle.
It's on linear.
Yeah,
that chart is a perfect
put it on
channel.
Yeah. If you put it on linear,
it's a perfect descending channel. But
I would tend to say, just for feedback, that when you are looking at very, very long time frame charts, log scale should be the one you'll use. But I will draw as you've asked, but just bear it in mind.
Yeah, no, the reason I haven't used a log scale on this one is because the numbers haven't moved logarithmically. So if the numbers move logarithmically, 1, 10, 100, 1,000, then you need to use a log scale. But if the numbers aren't moving logarithmically, then the linear scale should be more applicable. So the linear scale, you can also draw the support line there as well.
You've got a good reason. I just warn most people that will be listening to this on a technical analysis basis, big long-term, especially when you get percentage-based moves. I mean, the run-up here, blow-offs and major dumps, you want to bear that in mind.
But, of course.
Fair play to you. You've got your motives. So yes, you have broken. Either way, I think we're coming to the same point as well. We're in agreement in that this recent snapback has taken you through key levels, whether you run with my log scale or your justifiable reg scale.
It was just in reference to what you were saying about, if rates come back a little bit. My feeling is that you could get a bullish descending wedge on top of that descending yellow dashed line. So if you get a bullish wedge coming down to the yellow line there, that would for me sort of confirm that the yellow line has validity and that what you're getting is a I can imagine the narrative.
Return move.
Yeah, you can imagine the narrative. Oh, it's fine.
I'm not sure we'll even get that far. I think you could have a return move, but that doesn't return the full way. So you get it corrected. But if I just take the eye off, because I've got a lot of drawings and I've illustrated each big collapse in the staircase that they've been running down, and how this 3% blue line here was such a key level. But if I just take the drawings away, we did have a shooting star here, this candle here, and it's pretty exhaustive. So some degree of pullback, I think, is quite possible. The question is, how far down will you go? And I wonder if, the recession brings that down a little bit, but then they say, we don't care. They'll give it a while. They'll let everybody pull the debt markets because they still need a bid under debt. And then they go with the dollar strength again. And they say, we're still upping rates, red hot labor market, etc. And their fake narrative on that. But this is such a key chart. And I'm glad that you guys love it and are drawers on it as well, because it's such an important benchmark. But there is a slight pause now that we must bear in cognizance that there is this potential reversal structure. And this was a bit of an ugly gap as well, which shows, a little bit of skittishness.
Yeah. Can I just ask, can you put the 30-year over the 10-year?
Sure.
It's another one of our favorite charts at the moment. Myself and Patrick have been posting this one, so I'm quite keen to get.
I'm trying to figure on compare. I need a compare button.
Do the
plus.
plus.
I think it's on. Plus.
If you,
it's hiding somewhere.
Left-hand side.
Yeah, there we go. Yeah.
TYX.
And, you want the US 30-year.
Or TYX, whichever.
YX, perfect. That's even better.
When I said put it over, sorry, what I meant was TYX divided by TNX.
Oh, divide it out. Okay. Yep.
So if you go into the ticker and just type TYX.
Kevin, you know what we're doing to Francis now is what I do to you sometimes. Kevin, do that. Do your line there, Kevin. It's horrible. It's like
no. I like it. I love charting and I love other people's takes as much as anything. Charts are the closest thing we have to real truth here. And of course, we've had a lot of yield inversion
Yes.
that has occurred. We've had those sort of double dip yield inversion. And this is a broadening structure in of itself. The two divided by, I mean, this is the volatility. You can't look at central banks and say they've brought stability when you look at this, can you?
True.
One thing to note on this is the high points around about the year 2000 and around about the year 2008 and 2018 all correlate to low points in gold. So if you, I'm actually more used to having this flipped the other way up. So when you
want
put
me
it the
to
other
turn
way,
it around for you?
yeah,
I can do that.
if you invert it, it TYX over TNX. Yeah.
I must type there. Let's just fix that. TYX TNX.
That's it there. So quite an interesting point. You can see the 1% level or the 1 level as being pretty important, and that level around 1, each time this chart takes off from that level, the price of gold takes off.
Yeah, those were important bottoms in golds. You see, like the 99.
You can 2000, overlay
2005, or even 2018. That was a huge takeoff for gold in 2018, right?
If you hit the plus button in the top left hand corner and add gold, overlay the price of gold, XAU USD, obviously, and so you can see
it's created a separate window for it, but and if you can see the pauses and the pumps. And we are very, very, we are coming very, very close. There's two charts on, well, let's show you unemployment, because I think that one was up and I was able to get that one. Let me just go and show that to you, because that was key. I apologize that the library is just so incompetent. This is an interesting chart. I'm going to maximize this also just for the benefit of your viewers so that we get the biggest view fit to screen. So what are we looking at here? No, that's too big. Fit to screen is probably best. So we're looking, the yellow is essentially unemployment claims. And the white line is the stock market. So this is very much a New York composite. So it'll be like the Dow, essentially, very close to, I don't know if it's the 30 or the whole. The composite might be all Dow constituents. Now, if I, whoops, sorry, I didn't mean to do that. Let's get that back. I just want my draw tool. I think I shouldn't maximize that. It doesn't allow me my draw tool. Go back to just a tiny bit smaller and make it bigger manually. When you have a look at that, you can see that as unemployment is very low, at exceptional lows, on their bad number, which I would say. So you've got to take all the facts that we take in the stats. So these supreme lows, just before you have a major move up in unemployment. So these pink dashes that I've made, and I'm going to highlight them again in the same pink so that you can see them. So the final low in the yellow line, just before they have major moves up. So you see there's a pink line going up here. Let me, I'll do it in super fat and then I'll erase it so that I direct everybody's eyes, because there's a lot going on here. The final yellow low before it has a major move up into a localized high is the top of the stock market. That's what I'm showing on the green arrow here. You can see the green arrow, and the stock market trades down. So that's fairly obvious, but the timing is very good. So low unemployment into sudden spike highs call very much the highs on the stock market into the lows. So then when's the last low? Now that's the absolute low on the unemployment down cycle last time, but the final lows before it started going up were here. You kind of stabilized here. You had a dip low there, but then you're in a channel. You went steeply up then. Note, again, you're at the top of the stock market. And when you hit your peak on unemployment, you're at the bottom of the stock market. You see that. Now we've had, with this fakery and all forms of fuckery, I dare to say, with their stats, but this huge dip in unemployment to supreme lows unemployment, there was the final. This was COVID. So this is the crisis before the one we're about to experience, in my opinion. That's the final low, but that's the last low before you went very strongly up. Note again, it goes perfectly through the top of the New York stock composite, and then you trade it to the low down there on the white line. So now where are we? So if you've accepted that in principle and you've seen it now perform 3 times in a row, the key message is the final low before you start moving strongly up is the top of your stock market. And for me, I think that top is in. And the final low, you're already 20% down since, catching pretty much that. And for the first time, it's a teeny bit late. And the reason I would say it's a teeny bit late this time is because such was the violence of COVID up and down, there was very little adjustment time frame. It's almost like the event came out of the blue and it just killed the stats and it immediately just gapped. So we are technically in the beginning of a stock down that only ends when you go make a blue tag. So this is why I was using this color coding up here, an unemployment high. That will then be your bottom of your stock market. So let me go high.
That looks like it could be quite a way off looking at that chart, because we're still
a long way. This is my point. This again is my point.
And of course, if you look back at the 1970s, Francis, the stock market went down to sideways for what, 20 years?
Exactly. And it's hyper-stagflation. It's an accelerated version on both fronts of the 70 stag. So that was your low in the stock market. You see the circles. Now this one, the unemployment was there, but then it based for a long period and then only really started coming down here. So you had a spike, but then you had a channel, and then it began its journey down from this point. Down. So that was your low in the stock market. So
that's
if we again apply this to what's happening now, you've got to realize the volatility, and this is off the chart, the spike, it goes off the chart, the yellow line, and it's coming back down, just to understand. So now you're at the low, you got such a pump, which is why I get so frustrated by, there's a certain commentator, I won't mention his name, is saying, no, there's a 60% pump coming in the stock market in 4 to 5 months. And he just keeps repeating that as it continues not to happen. And he rolls it forward and has been doing for the last year and a half. And I'm saying you had more than a 60% pump. You went from 400 here up to 700 on the New York Dow. On the NASDAQ, you went from 6,000 to 16,000 in the space of the lows of the COVID lows to all-time new highs in a record time. You've had your pump. You are waiting now for the sell-off, and you part the way through it, and you're beginning, only just beginning, and the events are getting more volatile. This is my key point.
So follow the cap.
Look at the volatility of these things. This is somewhere going off the sky.
Look, I have 2 points.
More volatile.
I mean, this is, why I keep saying follow the capital flows, because if we're seeing shifts and rotations gradually away from, well, not so gradually, but away from general equities and the stock market, and bear in mind that we could very well not be looking just at a V-shaped recovery here, but if we draw parallels from the 1970s and the stagflation of the 70s and everything that occurred back then, whatever this ends up dropping down to, in my view, could take many, many years to recover from. And during those many, many years, of course, you've got inflation. So if you're in general equities for the next, say, 5 to 10 years, then even if the market recovers back to where it is now or where it's just been over the next 5 to 10 years, then your money's been eaten away by the effects of inflation. So follow the capital flows. Follow, where's that money going? Where is that money going? The US dollar, yeah. Commodity currencies, yeah. Commodities, yes. Precious metals, yes. Uranium, yes. This is where, in my view,
but money is also dying. I need to chip in and say this, because when you've created so much fake asset valuation on conjured up borrowed money, I don't see a cause for commercial banking. Once they have central bank digital tokens, we don't need a commercial banking industry. They can fold it. They can kill your bank balances and say, we're killing this industry. They screwed all you guys. Guess what? We'll make up with it. You can have a central bank digital currency. Pensions will be replaced with a CBDC allowance for those above 60. Yada, yada, yada. I'm talking about a full-on redraw, because the volatility is getting more volatile. And this is what the cartel of central banks have done. And how do you outdo this? Well, it's going to be something to watch. I tell you what, and I think it's a dangerous place. It's a very, very dangerous place, and people are going to be sitting waiting for their solution to come. And you probably won't have the unemployment number is going to go way beyond what you can't see the top of on this yellow line. And that means entire industries, people out of money, out of this, and it's going to be big, potentially. It could be very, very big. It doesn't have to be that big, but it could be very, very big.
That is a brilliant chart. So if ever you put it on Twitter, I'll retweet it, or else I'll create my version. Yes. But if there's one thing, when I look at your initial claims chart, go back to the 30-year divided by the 10-year. It's the same chart. Your yellow line looks exactly like the 30-year. Look at the volatility. It looks like the same thing.
Yeah.
It's a broadening funnel of volatility. And this keeps going back that I keep saying central bankers create volatility. They make money in pumps and dumps. They are essentially the crypto scammers, the original crypto scammers. You know, they are. And everyone who's a crypto scammer is running a microcosm of the central banking cartel. And this is all broadening structures. This is why we introduced into our HVF methodology the need for people to understand broadening structures and how they play out. Because we trade the squeeze. That's when you can get really beneficial risk-reward ratios. But you guys are spotting it and finishing my sentences for me here. Look at that structure. It's a megaphone. It's a huge one.
And I've noticed that, like, let's say money supply divided by GDP. Prior to 2000, it was flat. It was always money supply, but GDP was following. And after that, I think in 2000 or mid-90s, it just money supply destroyed GDP. It's like there's no link anymore between money supply and GDP anymore.
And that links directly to why we've got these broadening structures, because if you've got a graph going vertical on debt creation, then that is what ultimately, I suppose, is behind the fact that, you know, you're effectively, mathematically speaking, you're making the possible range of outcomes even bigger. Zero is always the downside, but as you're printing trillions and trillions and trillions of dollars and fiat currency, then the upside is going up vertically as well, and hence your broadening patterns.
Absolutely. And this is why we are positioned for the failure of the Hong Kong dollar peg. We're positioned on the Korean one, and we continue to hold these. And in fact, here I'll give a potential gift to your viewers in terms of something I shared in our premium community, a possible trade that will be ridiculous RRRs. And then when I say ridiculous, I mean absolutely ridiculous. So I've mentioned the USD Hong Kong dollar. Now, I'm not the only person that said the peg could fail, but how many people are giving trades, entry levels, targets, and stop placement? No one's giving you trades. No one's giving you RRRs. I'm about to do that for you, and we can sign off on this interview right there. And this is for all your listeners, and if they're grateful, they can give us all a retweet and a shout out. This is what our premium community was given this morning, and I'll let this one slip out. But if you go, and by the way, in any of my YouTubes, you can go to Simple FX, you can use USDC, Bitcoin, and you can open an account there, and you could put this on. But remember, it's hurry up and wait, because I can't tell you the day this happens, but I will point out that there's something that's occurred that I feel that could be bringing this trade forward. And here it is. And we're talking about peg failure. So if the USD, which currently isn't looking particularly strong. So first, I'm going to take you to the macro, the super macro. I'm going to wave goodbye to our gold chart here. Yep. And I'm going to just compress up for real estate. This was the first major move of the Hong Kong dollar way back. I'm talking the 80s, 1981, Asian crises, and I think it was also peak Volcker rates climb. That was ties with the gold, basically. And what I've said here is, if we have a similar scaled move, we've been in between these two blue lines, which is not an official peg, it's kind of a range peg, where they buy their lows and they've held it in that 7 points. Roughly, what are the two values I've given you? 7.7 and 7.85. So they've held it in that range for the better part. And remember, the longer they hold, 1st of August 83, that peg was put into institution. And my feeling is that this is due a break. And you have not spent, I'll analyze this, but the only reason I'm showing you the monthly is so that you can get a feel of how far it went. It went from back then around 4.6 And in actual fact, its highest point is way up here. So this is potentially conservative. I just took it to the low end of the range in percentage terms. If you were to get a similar base move from somewhere in the mid-range projected up, you could be looking at 13s. And I say that's the conservative target on a 7.85. So you're almost looking at an 80%. I would guess, without running the calculator, 75% currency trade on this, on a macro basis, similar percentage-based move. Now, you drop it down, you don't want to sit for 10 years holding this thing and paying for it. So what would be the reason? You want to get in at the last possible reason. And I want to highlight how few times you've spent long periods at the range. You had a spell here, and then you spilled back down on the dollar. This was 2019. You had the Shanghai Accord of 16, which was China getting into a lot of trouble. You had the spike there, then you had the run. It's been a very sketchy period, COVID, and they were banging up against us. Now, I can say to you that they are consuming, so the worst for listings, the worst half ever for Hong Kong, where they've made less than 10% of the normal IPO listings and money. People are afraid about Hong Kong. They think it's going to become China. And I don't blame them. So their reserves, which they have quite large reserves, but they are being burned off. And again, I shared a chart from Bloomberg, no less, and I will owe you a couple of tweets, and I will copy you guys both in of that chart. I will also do a commercial versus retail on gold and silver after this, once I've located them, and this one. But the key point is, if you want a real rainmaker chance at a trade, I'm going to say to you, well, if the dollar starts to reassert soon, you actually have here one of those rare events when you're at the ceiling and you've been trading, bumping up against the ceiling that has occurred before. So it doesn't mean it's going to happen this time and that I'm going to be absolutely right. It's a long shot. But when you see these RRRs, I will take these trades every time they're offered because they're absolutely huge. How many times, let me just cut out the exponential. How many times have you been through the blue line? Since 1981. Apart from the settling in and these crazy wicks, which could just as bad be bad data, you've only been this high that you are at now during the COVID period. All the other highs, you were capped a lot sooner. They've already let the ceiling bleed out to a point over here, and you've been pushed back once, twice, 3 times, and then it came back down. Now you have an ascending, we call an HVF, but you could also, in traditional technical analysis, if you're not familiar with our structures, say a triangle, an ascending triangle, where of course the flat top of this brush cut is you're watching a central bank intervene, guys, and they're burning dollars and they're getting less dollar income. So it's not a question for me if, it's a question of when. And now you just have to ask, if I put a stop under those 2 lows there, now what I chose to do, we've been filled here, and I've put a stop even under the low 2 here. Now, if you have a look at this risk reward, so to be clear,
I was going to say, what is the risk reward? That's crazy for
if you want to have a look at I could have technically squeezed it here. Now, obviously, that reduces your chances if you dip down through that low. So playing it safe and saying, I'm happy about the second low. Maybe you dip 1 or 2 more times here, and you may have a marginally lower low and a wick. I don't want to be taken out. But if you threw $100 at this trade, what would you get? So let's answer that question. So we'll finish on this as your runaway, the free trade from the sniper. And when I tell you that your risk reward ratio runs into absolute thousands, you will be shocked. There it is. Click on it and pull it to the top, all the way up to the 13. And you can see how small relatively that red is getting. I'm literally having to compress so much. Now have a look at the numbers that this generates. I'm going to go to the monthly, guys. Sorry, this framing is all cocked up. You have a 1,446 RRR trade. And you could put that stop a little bit lower. You could probably double that if you dragged it up to the other point. But, you know, you take on a bit more risk to the 13s. Plus, there's a scope for overperformance. You could do a 75% shut at that level. But you're going to be talking about macroeconomic events. You're going to talk about peg failure. You'll probably be seeing it on the DKK to the euro. You'll be seeing it probably the dollar Saudi riyadh. I showed Saudi's dollar debt is getting out of hand. A lot of things going on, despite them sitting on the oil wells they are. But you are looking right now at someone who's just made a case for almost a 1,500 risk reward. And you could probably push that to close to 3,000 on a peg failure event. And guess what? If you have to take that trade 10 times and you land it on the 10th time, you're not wrong 9 times. You're still a winner. Remember, it's not about being right or wrong in the markets. It's about how much money you make and how much of it you keep. That is a rainmaker trade. So let's be clear. If you put $1,000 or $500 on that every time, and you said, I'll do this 10 times, that there's a proper squeeze fractal on a short time frame, on the hope that by the time 10 is done. So I'll spend $500,000 of your money. If you had 500 on that, or 100, you're going to add 2 more zeros onto that 1,446. So you're going to go 14,000, you're going to go 144,000, and then you're going to multiply that by 5. You're talking about a 750,000 return for a $500 risk.
And that is proper
$750,000 return on a $500 risk. And if you wanted to make that $1 million because you'd love to do 1 millionaire trade, well, knock yourself out and make it 600 or 675 or whatever the number needs to be. And I don't think you're going to need 10 goes.
And there you go. That's proper risk reward money management right there, and that's what we're trying to teach people as well. That kind of risk reward and money management is all about.
Don't lose more than $500, and you can keep coming back to this well. And you're at a place that you've been rejected, only been that high before, in the most recent history.
Yeah,
in a country that knows what's coming.
And the point about this is you can lose 9 times out of 10 and have a minimal loss, and win 1 time out of 10 and have an astronomical, win.
And so many people, I've had so many people, oh, you were wrong on that call. I'm like, man, I'm happy to be wrong 9 times out of 10.
Exactly.
If my 10th is that.
Yes, exactly. Exactly.
So it's not about being right and wrong. It's about making money. And if you can manufacture really tight risk, and you've got to have that stop in there, it's got to be put in. You can't even go to sleep. You've got to have it in. You'll be great. You'll be golden. And one of those days you wake up. And this makes so much more sense. I see people who buy lottery tickets. I say, well, that's taxation for the poverty. If you want a lottery ticket, keep taking this trade 10 times, and you may not need 10 goes.
Fantastic.
That doesn't mean the first time you take it, you win. And it doesn't mean I'm an arsehole because it didn't happen for you the first time. That's understanding trading and markets. Exactly.
And that is a real gift for everybody who's watching this video right now, Francis. And I just want to say thanks for that, and thanks for sharing that, because
absolute pleasure. And this is what we seek to do for our community. I'll sign off here and I'll tell people where they can find off. How do I support my community in doing genuine stop placement? Lots of people will call Hong Kong peg fails. How many people will make you a millionaire on it potentially, and tell you it won't necessarily be the first time it comes, but you can guarantee a minimum loss of X, and you can fund that, and it's straight to, it's $1 million trade. That's without any overperformance, and you can close 75% or 80%, and you can leave overperformance. We have a method for overperformance, and we are focused on RRR trading, and it's not how many times you're right, it's whether you make money or not. And on my reset part of my 3 circles branding, it's how much of that you keep against overreaching governmental overlords that are actually seeking that unemployment rate to go to an all-time high, where everybody is reliant on government. You know that spike where the yellow line disappeared?
Yeah.
I think we've got to over prepare for the potential possibility that everybody is to be reduced to serfdom. And if I'm wrong, I'm happy to be wrong. But I'd rather start from a low base, and I live a happy world. I don't live in depression for it. I plan. Because if you take action and you build wealth and set up structures that you can retain and keep it, and we stack metal, we absolutely spot on with you guys. You're on the right trend. I encourage people to watch your content. You're absolutely on the right track. Silver and gold looking great. I owe you 2 charts that are on that as well. I will tweet all of what we've discussed, the charts out, and tag you both in. Thank you for having me on. www.themarketsniper.com. Book a call, talk to a trader that is a community member first, who never came and chose to take calls, but is now loves what we do and is happy to tell other people about it and demo our site, demo what we put out, our content, and get media from me on an ongoing basis and my take in the markets. Thanks, guys, for having me.
Jesus, Francis. You're the best, Francis. I love having you on there. So we'll have you on again for sure, man. You're I had to I could talk to you for hours, but I just wanted you to say what you had to say, and it's just great stuff, man. Super appreciate your time.
Yeah, thank you, Francis.
Thanks for having me. Please ask me again.
Will do.
All right.
All the
Take
best,
care,
guys.
Cheers, till next time. Remember, subscribe, like, and hit notifications for more.